Hello, my dear student. How are you all? Everyone fine? I am also doing great. Today in this video, we'll discuss the question number 1, which was asked in last examination, that is May 2024 attempt. The question was from consolidation chapter. It was related to consolidation of parent company with subsidiaries and associate. Means in that question, we need to apply Ind AS 110 in combination with Ind AS 103 and Ind AS 28. From a student point of view, it was totally new question. Why? Because the similar question was not in ICS study matter, RTP and MTP. However, similar question we have done in our batch. But whenever a question is not from ICS study matter or RTP, MTP, always it become a new question from examination point of view. Now, the question become important question. Why? Because for the first time they have asked this question. The question is that whether similar question can be asked in November 2024 exam. So I will say yes, it can be asked. So don't leave this question, even though it was asked in previous attempt, but it can be asked again in the next attempt. Happens in one of the question chain holding. Chain holding question was asked in exam twice simultaneously in one attempt after another attempt. But this point, the same question can be asked again in what November 2024 attempt. So don't ignore this question even though it was asked in previous exam. Got this point? Let us discuss the question. Question is very easy. Once you have understood what are the adjustment required, believe me, the question solution is very easy. Correct? Only one point we discuss in this question where ICA has actually taken three assumptions. So that particular point can be applied by taking three assumptions now from ICA point of view. Let us understand that particular adjustment. Okay, we'll do the entire question. Don't worry about that. Let us read the question first. The accountant of Mr. Ramesh Khanna of H Limited, the accountant Mr. Ramesh Khanna of H Limited submitted to you the following standalone balance sheet extract as at 31st March 2004. The balance sheet date is what? 31st March 2004. Okay, sir. Then H Limited, S Limited, A Limited, from the name it is understood it is a question of holding subsidiaries and associate. They have given non-current asset, property, plant, equipment, financial asset, investment. You can see H Limited has invested in 14,000 shares in S Limited. Correct? And H Limited also invested in 4,000 shares of A Limited. Now you can find out the holding ratio. You can see the share capital is how much it is. 2 lakh divided by 10 means 20,000 shares. It is 1 lakh divided by 10 means 10,000 shares. So we can say 14,000. It is 14,000 divided by 20,000. So can I say it becomes 70%? 70%. And 4,000 divided by 10,000. Can I say it becomes 40%? So we can understand that H Limited hold 70% in the equity shares of S Limited, and H Limited also hold 40%, which will give rise to significant influence of A Limited equity share. Therefore, A Limited become an associate of what? H Limited. Got this point? Yes, sir. Inventory is given, financial asset, cash and cash equivalent given, trade receivable given. Then equity shareholders fund means shareholders and equity given. Equity share capital of rupees 10 each. Other equity retained earning is only given. Then non-current liability on liability has been given. Financial liability, that is borrowing. Current liability, only one liability, that is trade payable is given. Okay, sir. Very. So small balance sheet. The following additional information is made available in respect of this company. H Limited purchased the shares in S Limited on 31st October 2023 when the retained earning of S Limited was 5 lakh. So you can see the date of acquisition was 31st October 2023, and the good point is that they have given retained earning on the date of acquisition only. Means the time adjustment is not required. You can see on 31st October being the mid of the year, but their retained earning on that date is given. Means can I say this 5 lakh become entire pre-acquisition profit? So only you need to find out post-acquisition profit. Got this point? And the shares in A Limited were acquired on 30th June 2023 when the retained earnings stood at rupees 1,75,000. Understood this point? Correct? So it means the investment in investment A Limited was acquired on 30th June 2023, and on that date retained earning has been given, that is 1,75,000. Inventory of A Limited as on 31st March 2024 include inventory valued at rupees 60,000, which has been purchased from H Limited on 1st Jan 2024 at cost plus 20%. It means inventory of A Limited will include some profit of H limited. So it become a downstream transaction for associate. So some inventories were sold by H limited to A limited. So stock of A limited will include some profit of H limited that need to be eliminated. Got this point? Yes sir. Chalega. Then trade payable of H limited include 25,000 payable to A limited and the amount receivable being recorded in the receivable of A limited. So there is some intercompany balance between H limited and A limited, but as per India's 28, the intercompany balance will not be eliminated. Therefore, this point is of no relevance. Correct now. So you can see trade payable of H limited will become the trade receivable of A limited. So because any assets and liability of associate company will not be incorporated here recognized in the consolidated financial statement of H limited, there is a question of cancellation will never arise. Therefore this point is of no relevance. Chalega? Yes sir. Point number 4, goodwill in respect of the acquisition of S limited has been fully impaired. The recoverable amount of the investment in A limited exceeds its carrying value as on 31st March 2024, and NCI is valued at proportionate share of INA. Correct. So three information has been given. Whatever goodwill will calculate from subsidiaries company point of view, that will be fully impaired, and they have given the investment in A limited. The recoverable amount will be more than carrying amount. Therefore, there is no impairment loss for investment in A limited. So for that nothing to be done, and NCI need to be calculated by using proportionate share in INA method, that we know. Chalega? Yes sir. Point number 5, this was actually a point where a lot of confusion came in exam, and from my point of view, whatever student have done, that assumption has been taken into consideration, and therefore ICI has given three assumption for this particular point. Means from my point of view, three assumption can be taken by the student in exam hall, and same assumption has been taken by institute. It means now institute is also clear about assumption. So what, whenever you have doubt, take assumption, institute will give marks. Don't leave the question in exam hall. Got this point? Yes sir. So 10% dividend, 10% dividend where it will be where declared by both H and S, whereas A limited declared 15% dividend for the year 2023-2024. Correct. So it was dividend declared for the year. It is given for the year 2023-24, means for current year. So normally what happened, the current year dividend will be declared after reporting date if it is final dividend. If it is final dividend, we can also assume it is interim dividend. Now, interim dividend of current year will be declared in current year and paid in current year. Got this point? Two assumption, I will say two assumption was actually eligible, but because of point number 7, there were three assumptions. Got this point? Let me read the entire question first. On 31st March 2024, S Limited made a bonus issue of 1 equity share for every 2 shares held by the shareholders of S Limited. The bonus shares were issued. Dividend were declared, but were not accounted for by all these company in the books before the year end. So what they have said, it is not yet accounted. So no journal entry has been done. No journal entry has been done. Understood? Now because of this point, lot of confusion came in exam. What actually the question want to say. Correct? Similarly, the bonus issued by S Limited was not reflected in the balance sheet as on 31st March 2024. The bonus shares no journal entry has been done. This point okay, we have understood, because similar question we have done in our class, and similar question has been given in the previous examination question also. The bonus shares declared but no journal entry has been done. So of course we know about this. Now only we need to now understand point number 5 and point number 7 related to dividend. What can be the possible assumption from examination point of view? You are required to take a note of the above available information and draw the consolidated balance sheet of H Limited as on 31st March 2004. Notes to account are not required. So notes to account are not required. A question of 40 marks, a compulsory question was asked. Now let's see point number 5. What they have said, 10% dividend were declared by both H and S as well as by A Limited also, but A Limited declared 15% dividend. But they have said no company has accounted this dividend in their books of account. Correct? So one assumption is what, that one assumption which can be taken by the student in exam, that this dividend is declared after reporting date, after balance sheet date, means after 31st March 2024. So can you see if the, because of this point number 7, that confusion started. So they have said no journal entry has been done. No journal entry has been done. So of course can you say dividend declared after reporting date, so no journal entry is required. Correct. So that assumption can be taken. If that assumption is taken, then can you say no adjustment is required? Then ignore this transaction. entirely. Ignore this transaction entirely. Correct. Second assumption can be taken that this dividend whatever has been declared can be interim dividend. Can be interim dividend. So it can be dividend declared, but because of the point number 7, because of the point number 7, can I say because no journal entry has been done, so we can assume that dividend declared but not paid. Dividend declared but not paid. Understood? So we can take one more assumption that dividend has been declared before reporting date. It can be interim dividend, it can be interim dividend now. So dividend declared before reporting date but not paid, but not paid. Now it can be one possible situation that you can also assume that accounting entry has not been done, so it can be an error. So dividend declared and paid, this can be third assumption. So from my point of view, most of the student has taken first assumption in exam, and if you have taken first assumption and if you have done correctly, the full marks will be allotted to you. So what are the three assumptions? First, dividend has been declared, means you can assume it is a final dividend. Final dividend, so final dividend of current year, the final dividend of current year will be declared after reporting date. So any dividend which you declared after reporting date, no journal entry is required. So first assumption can be what? Dividend has been declared after reporting date. Second, it can be interim dividend. So we can assume that dividend has been declared before reporting date, but the amount has not been paid. But the amount has not been paid. And third assumption that dividend has been declared before reporting date, but amount has been paid, means dividend has been paid. These are the three assumptions which can be taken for point number 5 and point number 7 in combination. So they have also given same only. You can see accordingly following assumption are possible based on which alternative solution have been provided. Assumption number A, what they have taken, ignore the adjustment for dividend completely as dividend has to be approved in the annual general meeting. Means they have assumed that dividend has been declared after reporting date. Chalega. Second, consider dividend as declared but not paid. Third, consider dividend as declared but and paid. So these are the three assumptions based on which we can do the solution. Can we take the solution? Yes sir, we can take the solution. So come to the solution part. Already I have drafted the solution for you. So I'll just explain the entire solution. Okay sir. So come to solution. So you can see assumption number 1, dividend is declared after reporting date, that is 31st March 2024. So can you say ignore that adjustment? Ignore that adjustment because as per India's 10, any dividend which you declared after reporting date cannot be recognized as a liability, and no journal entry has been done. So because no journal entry has been done, the this particular assumption is possible. This particular assumption is possible. Chalega. So in this case, first we'll do working note number 1. We'll prepare analysis of profit of S Limited. Analysis of profit of S Limited. So you can see they have given only retained earning. So we'll do what? Closing balance minus opening balance. This will be the profit after appropriation. Profit after appropriation. But dividend, no journal entry, correct now. So minus plus final dividend, nothing because you will not add back because we want profit for the year. So plus final dividend, pay, plus final dividend, nothing has been paid, no adjustment. So nothing will be done now. Are you able to understand? And bonus here, because journal entry has been not done, therefore no adjustment is required. No adjustment, nothing will be added to find out a profit of current year. Nothing will be added to find out a profit of the current year because no journal entry has been done for the bonus years also, correct? So this become profit for the year. This become profit for the year, but this profit will be entirely for what? Post acquisition period. Entirely from post acquisition period, because this opening balance they have given as on the date of acquisition, because they have given opening balance as on the date of acquisition, and this is on the date of consolidation. So any profit between this will be entirely belong to post acquisition period, and the time adjustment is not required. So this 2,50,000 will be allocated entirely to post acquisition period, and the opening balance whatever has been given, that will be pre-acquisition profit. Pre-acquisition profit. Now can I say bonus years? Bonus years, because journal entry has not been done, so we need to think about journal entry. Journal entry will what? It will be retained earning or reserve and surplus, because there is no other reserve and surplus given. So we can say retained earning account debit to equity share capital. To your retained earning will decrease by the amount of bonus shares. By the amount of bonus share, it is given that they want to declare bonus shares in the ratio 1:2. So there is 2 lakh equity share capital. So 1 by 2 it will become 1 lakh. So 1 lakh will be the bonus shares capital. So we'll do less bonus shares, how much? 1 lakh. Less bonus shares, how much? 1 lakh. So this will become 4 lakh and this become 2,50,000. However, if the bonus share journal entry has not been done, so you can apply one shortcut by ignoring that transaction fully from consolidation. Means ICI in some question have done in this way. In some question, means in the last exam question, this question they have ignored it entirely. So that depend upon कि how much conceptually you are to understand the particular solution. Got this point? So I am just doing this, but ultimate effect will be nullified. Ultimate effect will be nullified. So you can also ignore bonus year adjustment entirely from the solution. Correct? Chalega. So less bonus years, I have done less bonus years. So this will become pre and post acquisition profit. So pre become how much? 4 lakh, and post become how much? 2,50,000. Understood this much? Now I'll prepare statement of net asset. Statement of net asset. This will be the date of acquisition. Date of acquisition. This will be profit, means retain earning, correct now, and date of consolidation, correct. To equity share capital they have given 2 lakh, 2 lakh. Now equity share capital is before bonus year, therefore we need to add bonus years यहाँ पर. तो we'll do add bonus years how much? 1 lakh. Add bonus years 1 lakh. If you are ignoring, then you need to ignore completely. You need to ignore it completely. चलेगा. Ultimately the answer will remain same, correct. I'll inform you how the answer will remain same. Now retain earning, already we have done working note number 1. 4 lakh become what? Pre, and 2 lakh 50 become post. So 4 lakh pre and 2 lakh 50 post, the total becomes 6 lakh 50,000. Now you can find out INA on the date of acquisition, and this become the post acquisition profit, and this become INA on the date of consolidation. Because there is no fair value adjustment, so nothing to be done. So book value of INA will be assumed to be the fair value of INA. Understood? Have you understood this point? Suppose you have ignored bonus years entirely. So if you want to ignore bonus year entirely, so this will be 5 lakh. This will be 5 lakh, because if you ignore, this will be 5 lakh. Correct. Now 5 lakh minus 0 is equal to 5 lakh, and here what you'll do, this will be 0 and this will be 5 lakh. So ultimately your answer will remain same. So what ICA has done in their solution, they have ignored bonus year adjustment entirely, but in previous exam question they have done some adjustment to make the doubt clear. I have done in some other way as ICA has not done. Chalega? Yes, sir. So in both cases the answer will remain same. In both cases the answer will remain same. Working note number 2 also you have understood. Chalega? Yes, sir. Now we'll come to working note number 3. We'll calculate goodwill or gain on bargain purchase as per Ind AS 103. So we'll find out fair value of consideration paid. So how much they have paid for 70%, it is given in the question only. So 70% they have acquired at what amount? Check karo. They have acquired at 5,60,000. So this become the cost price of investment. This become PC. Now we'll find out NCA by using what method? Proportionate share in INA method. That will be 30%. to 30% of 7 lakh, 30% of 7 lakh will be calculated. That will be 2 lakh 10,000. The total will be 7 lakh 70,000. Then we'll minus fair value of INA on the date of acquisition, that is 7 lakh, and the goodwill will be 70,000 on the date of acquisition. Goodwill will be 70,000 on the date of acquisition. From this we can also deduct minus impairment loss, because they have already said the impairment loss, it is fully impaired. So minus 70,000, and this will become nil. This will become nil. And can I say this is a partial goodwill? This is a partial goodwill. Why it is a partial goodwill? Because we have used for NCA measurement proportionate share in INA method. Whenever partial goodwill, this entire impairment loss will be only attributable to parent company. Got this point? Yes, sir. Working number 4 will come. Now we'll apply Ind AS 28. Now we'll apply Ind AS 28. So we'll do application of equity method for investment in associate. Application of equity method for investment in associate. So first we'll calculate goodwill or gain on acquisition, and that gain on acquisition is ultimately transferred to capital reserve. Chalega? So calculation of goodwill or capital reserve will do. So we'll do cost price of investment, that is given in the balance sheet. 40% was acquired at rupees 1 lakh. If you want to check karo. So it was acquired at rupees how much? 1 lakh. So cost price of investment is how much? 1 lakh. From this we'll deduct 40% of fair value of INA on the date of acquisition. 40% of fair value of INA on the date of acquisition. So equity share capital of associate is how much? 1 lakh. And now they have given retained earning on the date of acquisition. They have given retained earning on the date of acquisition. In the additional information, if you read, they have already given 1,75,000 on 38 June 2023. Correct now. Therefore, no adjustment required. So on the date of acquisition, the retained earning was 1,75,000. So this plus this will become the INA on the date of acquisition. Correct. We'll take 40% of this. We'll take 40% of this. This will become what? 40% of fair value of INA, 1,10,000, and you can see there is a gain on acquisition which will be ultimately transferred to capital reserve. Means if there is a goodwill, then that will not be recognized. But if there is a capital reserve, that will be recognized by passing one journal entry. Journal entry will what? Investment account debit to capital reserve, and this capital reserve will come in the balance sheet. Chalega? Yes, sir. Then we'll find out value of investment in A Limited as per Ind AS 28. As per Ind AS 28. Okay, sir. Yes, sir. So cost price of investment is given 1 lakh. In this we'll add capital reserve 10,000. Then we'll do sharing profit from associate. So what is the opening balance means on the date of acquisition how much given, 1,75,000. Closing balance is given 4,24,000. So 4,24,000 minus 1,75,000, 40% will be the profit which will be recognized in the parent company consolidated financial statement. The 40% will become 99,600. chalega, correct. Now once again just try to understand, because in this particular point also dividend declared by associate company was actually declared after reporting date. So the question of dividend received or receivable will not arise. So therefore dividend point has been ignored. However, any dividend received or any dividend receivable should be also deducted. But if this is not declared, the question of receipt will not arise. The question of dividend received will not arise. Therefore dividend adjustment has not been done. Understood? Now there is one more transaction given in the question about the unrealized profit for the goods sold by holding company to associate company. So in the stock of associate company there will be some profit of holding company that required elimination. So goods sold was 60,000, that remain unsold. The profit was 20% of cost. 20% of cost means 20 by 120 of sales, correct? Now so we can do 20 by 120, correct, and the 40% we can calculate. 40% we can calculate, so this become 4,000, correct? 4,000, this amount you can easily calculate. Now what is the journal entry for elimination of URP in case of downstream transaction? So journal entry was retain earning account debit to investment, retain earning account debit to investment. So it means retain earning will also decrease and investment account will also decrease. Retain earning and investment account both will decrease. So we have done, you can see we have reduced investment by 4,000. We have reduced investment by 4,000. So what happened? The value of investment as per equity method, it become 2,05,600. 2,05,600. This also you have understood? Okay, sir. Yes, sir. Now be careful about this particular transaction. If the downstream transaction, then journal entry is retain earning account debit to investment. If it is upstream transaction now, then journal entry is what? Sharing profit from associate to inventory. Sharing profit from associate to inventory. So be careful about this particular transaction. Okay, sir. Now we'll come to working note number 5, other equity and NCI. Correct, last working note. So retain earning NCI, this balance will take from parent company balance sheet. This NCI will take from the previous working note, whatever we have calculated by Pasina method. Then first we'll add sharing profit from subsidiary company as per statement of net asset. Whatever we have calculated, the profit was how much? Check karo. So in statement of net asset it was 2,50,000 profit. So this 2,50,000 will be allocated to both party, means parent company NCI, in 70:30 ratio. We will allocate into 70:30 ratio, it can be allocated. Then we'll take sharing profit from associate. Sharing profit from associate means this 99,600 will be also added. So it has been added only to parent company. Got this point? Then URP, whatever we have eliminated, that will also reduce return earning. You can see URP on unsold stock, that will be also reduced. This is double effect. And there was one impairment loss of 70,000, that will be also reduced from return earning, because that is entirely attributable to parent company, therefore will not be allocated to NCI. So 70,000 will be also allocated. If it is full goodwill, be careful, it will be allocated to both parent company and NCI. This become the balance of our return earning and NCI. Super easy. Now we can prepare the balance sheet. So let us start the balance sheet. Balance sheet become what? PP. Do plus because there is no adjustment, but be careful, the any assets and liability of associate will not come. Any assets and liability of associate will not come. Got this point? Correct. So PP become 5,50,000 plus 4,80,000. Chalega. Then goodwill is coming. Goodwill will become nil. As per our working note, goodwill will become nil. Then financial asset, investment in associate will come as per our working note. And what was the amount? It was 2,05,600. So investment in associate will come as per working note. Then current asset inventory plus no adjustment is there. Correct. Adjustment. URP was inventory of which company? Associate. So that will not be adjusted now. Correct. And what journal entry we have done for URP of inventory of associate? The journal entry was retain earning to investment. So already reduced from investment. Don't reduce from inventory. Correct. Then trade receivable, no adjustment. Cash and cash equivalent, no adjustment. Chalega. Balance sheet amount came. Then equity share capital, no adjustment. Other equity will be what? Whatever other equity we have calculated, means this retain earning will come. Plus there is one capital reserve for associate company. Whatever we have calculated, capital reserve will be 10,000. So 11 lakh plus 11 lakh 600 plus 10,000. It will become how much? You can see it will become 11 lakh 10,600. Okay, sir. This also you have understood. NCI will come as per working note. Financial liability, no adjustment. Trade payable, no adjustment. Plus karo, the balance will tally. This is the first First, taking first assumption, we have done the balance sheet preparation. Now what we'll do, we'll take assumption number 2. Can we take? Yes, sir. The assumption number 2 is what dividend is declared before reporting date, but the amount is not paid. Amount of dividend is not paid. Correct? Now you must be thinking that, sir, we have understood assumption number 1. That is more easy because we have ignored the entire dividend transaction. That become more easy solution. So why to understand assumption number 2? Correct? This might be in your mind right now. Simple, just try to understand what I am saying, that in your exam question there may be a point that dividend declared before reporting that but the amount is not paid, then you can't apply assumption number 1. In that case you need to do as per assumption number 2 only. So better do na. Why to take risk from examination point of view? Chalega, it is also easy. Let us start discussion. So in this also we'll first prepare working note number 1. So working note number 1 will be analysis of the profit of subsidiary company, retained earning. You can see closing balance 7,50,000, opening balance on the date of acquisition they have given 5 lakh. The profit after appropriation will be 2,50,000. Correct. But in this case also dividend journal entry has not been done because the amount was not paid and therefore nothing to add back. Bonus year journal entry also not done. There's nothing to add back. So this become the profit earned during the year, means during the post acquisition period. The entire profit will be allocated to post acquisition profit. Opening balance will be pre acquisition profit. Now can I say we'll do minus dividend paid, minus dividend declared, means dividend payable. It will be dividend payable. So we'll say minus final dividend payable. Minus final dividend payable. Why? Because can I say, of course, if they have not done journal entry, so we need to pass one journal entry for dividend declared. Dividend declared but not paid. Not paid means it is payable. So one journal entry will be what? Return earning account debit to final dividend payable. So final dividend payable will reduce. And bonus years, let us take the same point of view whatever we have taken for assumption number 1, ki minus bonus years 1 lakh will do from pre-acquisition profit. Bonus year, even though question is silent, always will deduct from pre-acquisition profit. So bonus year, if the question is silent, always deduct from pre-acquisition profit. Don't deduct from post-acquisition profit. Chalega. So this become 4 lakh and 2,30,000 now. This much you understood? Yes, sir. Now prepare statement of net assets. Statement of net asset. You can see equity, share capital, date of acquisition and date of consolidation will come. Now bonus year, because the equity share capital is given before bonus years, so it will be bonus years 1 lakh, 1 lakh will come. Then retain earning as per previous working note, it will be 4 lakh and 2,30,000. The 4 lakh and 2,30,000 we write down. This will become a statement of net asset. So this become INA on the date of acquisition. This is the post acquisition profit after dividend, and this is the this is the net asset on the date of consolidation. Chalega. Then we'll calculate goodwill or gain on bargain purchase. It will be same to same because the information related to this particular working note does not changes. So you can same working note will do, and the goodwill will come same 70,000. However, impairment loss is there 70,000. So therefore goodwill will be nil. Correct. This you can calculate by your own. Chalega. Then we'll come to working note number 4. But before that, I just want to explain the dividend adjustment. If you understood this dividend adjustment, you can do other working note very clearly. Now they have H Limited has declared dividend of 10%, but a journal entry has not been done. So what will be journal entry? Retained earning account debit to dividend payable. Retained earning account debit to dividend payable. What are the two effects? What are two effects? Here is retained earning will be reduced by 50,000 and dividend payable will be shown in the balance sheet as a liability, as a current liability. Chalega. This you have understood because journal entry need to be done, na? Yes, sir. Now, in the books of dividend declared by S Limited, dividend declared by S Limited. First, in the books of S Limited, okay, retained earning account debit to dividend payable. This already we have done. Retained earning you can see in AOP already we have done. Retained earning we reduced by 20,000. Correct. So in the books of S Limited, the journal entry retained earning account debit to dividend payable. Now can you say whatever dividend declared by S Limited will be receivable by H Limited? Therefore, H Limited should pass one journal entry. What journal entry? They will do dividend receivable account debit to PL, and PL, from PL it will go to retained earning only. So dividend receivable to PL and from PL it will go to retained earning. So this dividend receivable should come in the standalone balance sheet of H Limited as a current asset. Correct. And retained earning will be increased by how much? 14,000. 14,000. Why? Because 70% of dividend amount, 70% of 20,000 is 14,000 only. Got this point? But can I say in consolidation, the dividend payable by S Limited and dividend receivable by H Limited will be a contra item because this represent intercompany balance. This will be cancelled. So we'll pass one journal entry dividend payable to dividend receivable. 14,000, 14,000 will be cancelled. 14,000, 14,000 will be cancelled. Means can I say only dividend payable to the extent of 6,000 will remain in the balance sheet. Means out of this 20,000, 40,000 cancelled, and out of this 14,000, 14,000 entirely cancelled. Got this point? It means dividend payable to the extent of 6,000, which represent dividend payable to non-controlling interest, will remain in the balance sheet. So dividend payable will remain in the balance sheet. How much? 6,000 in consolidated financial statement. Correct? And we need to decrease retained earning of subsidiary company by 20,000, already done in AOP, and we need to increase the retained earning of holding company, means parent company, by 14,000. This we need to do. Correct? Now coming to books by A Limited, dividend declared by A Limited. Dividend declared by A Limited. Can you say any dividend declared by A Limited will be received by whom? Will become receivable by whom? H Limited. So right now we are preparing consolidated financial statement of H Limited. So any dividend declared by A Limited will be receivable by H Limited. So in the consolidated financial statement of H Limited, we will pass one journal entry, dividend receivable to H Limited. Sorry, dividend receivable to investment account, dividend receivable to investment account. So dividend receivable to investment account in the books of H Limited for the amount of dividend receivable. Correct? So dividend receivable to investment account. What amount? Amount will be what? It will be how much percent? 40% of the dividend declared, and the dividend declared will be, it is 15% of 1 lakh. 15% of 1 lakh means 15,000, that is coming what? 6,000. So this journal entry will be done, dividend receivable to investment, means if received then will pass journal entry bank account debit to investment. If not received, then dividend receivable to investment, and this dividend receivable will come in the balance sheet. This dividend receivable will come in the balance sheet, in the consolidated balance sheet. I hope you have understood. Have you understood this entire adjustment? Once again I will inform you. Any dividend declared by H Limited, what journal entry? If the journal entry is not done, retained earning account debit dividend payable, this dividend payable will come in the balance sheet in CBS. Correct? And retained earning of H Limited will reduce by 50,000. Then dividend declared by S Limited. First, in the books of S Limited, one journal entry, retained earning account debit dividend payable. So we have already reduced in AOP dividend amount how much? 20,000. Then in the books of H Limited, can I say it will become receivable by H Limited? So one journal entry will do dividend receivable, will do one journal entry, dividend receivable to PL, dividend receivable to PL, and from PL it will go to retained earning, from PL it will go to retained earning. Chalega? So dividend receivable to retained earning. Got this point? Now this dividend receivable should come in the standalone balance sheet of H Limited as a current asset. But in CBS, can I say this dividend receivable 14,000 and this dividend payable to the extent whatever is payable to H Limited should be cancelled. So 14,000 will be cancelled. Only dividend payable to the extent of NCI, to the extent amount payable to NCI, will remain in the consolidated balance sheet. This you have understood? Yes, sir. Chalega. Then dividend declared by A Limited, whatever dividend declared by A Limited will be now receivable by H Limited, will be receivable by H Limited. So simple journal entry is what? Dividend receivable to investment in associate, 6,000. 6,000 amount means this is 40% of 15,000 dividend payable by which company? Associate company. Got this point? Yes, sir. I hope you have understood. Now you can understand what we have done. So first we'll once again come to working note number 4, that is application of equity method for the investment associate. So calculation of goodwill or capital reserve remains same, and 10,000 capital reserve will come as in the previous whatever we have done. 10,000 capital reserve will come. Only what will change? Value of investment A Limited as per Ind AS 28 will come, because यहाँ पे dividend receivable accounting entry will be affected. चलेगा? तो 1 lakh was the cost price of investment plus gain on acquisition transfer to capital reserve will come. This amount will also come in the balance sheet capital reserve as a capital reserve. This become total amount. From in this we'll add share in profit from associate, same amount whatever we have done in previous calculation, that is 4,24,000 minus 1,75,000 into 40%, then minus dividend receivable. Why? Because this is inclusive of total profit. Now this is inclusive dividend. Correct? So dividend receivable deducted, what will do? What journal entry? Dividend receivable to investment account. So minus from investment will do dividend receivable 6,000, and this dividend receivable will also appear in the balance sheet as a current asset. Okay, then share in URP, already we explained in the last assumption, 4,000, that become 1,99,600. Chalega? Yes, sir. Then other equity, thoda sa interesting, the 9 lakh is the balance from parent company. This is from previous working note, 2,10,000. 2,10,000. Okay, yes, sir. Then share in profit from S Limited. Now it will be 2,30,000. 2,30,000, 70%, 30%. Allocate karo. Then share in profit from A Limited, 90,000, 99,600. Already we have understood this point. Then URP also we have understood. Impairment loss we have understood. Only dividend adjustment. So you can see one was dividend declared by parent company. Dividend declared by parent company 50,000 reduced from retained earning, and dividend receivable by H Limited from S Limited, that 14,000 will be added now. So that dividend income receivable from S Limited, that 14,000 has been added because that journal entry was not done in the balance sheet of H Limited, that need to be added. So we have added that. These 2 points you need to understand. If you have understood these 2 points, means chalega. Have you understood this particular point? Follow. Have you understood this particular point? I hope you have understood. Chalega. So this become the working note amount, and now you can prepare the balance sheet CBS. Now CBS you can do it. Only in the balance sheet what will come? Dividend receivable will come 6,000 and dividend payable will come 50,000 plus 6,000. This 6,000 is the dividend payable by S Limited attributable to NCI. However, it can be also shown as by way of addition to NCI. Means this 6,000 can be added to NCI also, but ICI is not taking that particular presentation, so we'll also show dividend payable separately only. However, this 6,000 from my point of view belong to NCI, can be added to NCI also from my point of view. But as per ICI solution, they are showing it separately, so better show it separately only. Chalega, got this point? I think balance you can do by your own. Correct? Don't worry, this PDF will be given as a link in the description of this video. You can download and then verify your answer. Now come to last assumption, assumption number C. You can see assumption number 3, dividend declared before reporting date but also paid by all the respective company, but no journal entry has been done as per the information given the question. Now last assumption means assumption number 2 and assumption number 3 are more or less same because dividend declared before reporting date. Only the payment has been done in this assumption. In the last assumption means assumption number 2, payment was not done. So all the working note will remain same. Only the journal entry, whatever I have explained in assumption number 2 as per payable and receivable, now it will be through bank account. Got this point? So let me explain only what the adjustment entry for that particular point, and automatically if you have understood you can do by your own. Chalega? Yes sir. So what we are doing, dividend declared before reporting date and paid but no journal entry has been done. So first dividend declared by H Limited, what journal entry will do? Retained earning account debit to bank. Retained earning account debit to bank 50,000. It means retained earning of parent company will reduce by 50,000 and bank of parent company will reduce by 50,000. Chalega? Yes sir. Then dividend declared by S Limited. So there will be two effects in the books of S Limited and in the books of H Limited. In the books of S Limited, retained earning account debit to bank. So AOP of subsidiary company will reduce by 20,000 and bank of subsidiary company will also reduce by 20,000. Chalega? And books of H Limited, because they will receive the dividend to bank account debit to PL, and from PL it will go to retained earning. So bank of H Limited will increase by 14,000 and retained earning of H Limited will also increase by 14,000. You can give the entire effect. Understood? Means ultimately the effect will remain same. Only because of bank, because in this bank will be adjusted in the last assumption, payable and receivable were adjusted directly in the balance sheet. Chalega? Yes sir. Then last, dividend declared by A Limited. So of course we are not going to pass journal entry in the books of A Limited because A Limited assets and liabilities are not affected, they are not adjusted in the parent company consolidated finance statement. Only whatever dividend received will be accounted to dividend received. Now bank account debit to investment account. So you can see in the last assumption we have done dividend receivable to investment. In this we'll do bank account debit to investment. So bank of parent company will increase by 6,000. Investment already we reduce, means already we will reduce in the investment calculation, that is investment in associate, by how much? 6,000. So this is the ultimate adjustment which you have understood. I hope you have understood. Chalega? Yes sir. Now coming to the balance sheet, I will show the what adjustment they have done. You can see the entire balance sheet remains same. Only the dividend receivable and dividend payable will not come in the balance sheet now. Dividend receivable and dividend payable will not come in the balance sheet. So what will come? Cash and cash equivalent. You can see cash and cash equivalent 89,000 of parent company is given, has been reduced by 50,000. Reduced by 50,000. Okay sir. Then increase by 14,000 dividend received from subsidiary company. Then increase by 6,000 dividend received from associate company. Then 98,000 is the cash and cash equivalent of subsidiary company, that is reduced by dividend declared by them, that is 20,000. This if you have understood you can do by your own. Okay sir. I hope you have understood the entire assumption. The question is very important. Why important? Because similar type of question can be asked. And can I say, of course, you should practice this question because this will help you to understand all the adjustment. Even though they have given in three particular assumptions, but in exam, quite possible in your exam, they may ask that they may ask a specific point in the question, so must do this question before exam, because similar question or similar type of adjustment can be asked. Even though they ask only parent company and subsidiary company, they may ask you the similar type of adjustment. It will be good for practice, so must do this question before exam. I hope you have understood. If you like this video, don't forget to like this video and don't forget to share this video with your friend, so that they can also understand what type of adjustment is required in this particular question. I hope you have understood. All the best for your preparation. Love you all. Bye bye.